The car that I
We'll talk
want
more about that.
has
But
was
that's
allocated
when
on
the Feds doesn't raise rates anymore.
October
That's
20th.
historically,
And they said it
stocks
was
and bonds
supposed to
are
go on a
rallied.
vote
So I'm bullish.
October 31st.
And it'll be a 24th.
Yeah.
24th, and here it's going.
It might get,
We'll talk about that.
it might.
All right. Well, good morning, everybody. We are at the top of the hour. Sorry to interrupt, but we've got some people online, so we want to start right on schedule. So thank you guys all in the room here for being here in person with us. We really do appreciate you taking the time to be here and taking the time out of your busy schedule. For those of you online or in the recording, we also want to thank you for being here today. We appreciate you taking the time out of your busy schedule. Today is Thursday, November 16th already. Next week is Thanksgiving. How crazy is that, right? I can't believe we're already this late in the year. It seems like it's just flying by.
You barely got back from your hunting trip.
You barely got back from hunting. Yeah, we did a good job over there too. So our agenda today is to hear from our Chief Investment Officer, Tom Fox, as always. He's going to give us an update on the positives, the negatives, and what he thinks it means moving forward. For those of no new faces in the room, so all of you already know this, but for those of you maybe online or in the recording that don't know, my name is Eric Hagan. I'm a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, Chief Investment Officer Tom Fox, financial advisors Rana Grant and Dan Oshman. If you are a guest of Rana or Dan online or in the room here, thank you so much for being here. And then our client support team, John Knutson and Marilyn Westmark. Together, our goal is to help individuals, couples, and families make your next financial decision, and then the one after that, a good one. And so pretty straightforward there. So again, our agenda today, we're going to get right into it. We're going to bring Tom up here. He's going to talk about the headwinds or the things that maybe we're worried about, and I like to say watching closely. I'm going to talk about the positives. There are a lot of positives happening in the markets right now. And then he's going to talk about an outlook for the rest of the year and beyond. And so with that, let's go ahead and bring Tom up. Tom has an extensive resume. I'm going to throw it up there on the screen. Take me about an hour to read all of that, so we'll let everybody read it. But
Thank you.
Thank you for being here. Appreciate
Thank you, Eric. Hello.
While Tom is talking, one last thing. If you have questions online, please do not hesitate to post them in the comments section. Or if you'd like to be a little bit more private, you can email them to me and I will field them to Tom at the end of today's message. If you're watching in the recording, same thing. I'll be coming back and reviewing all of that. We would love the opportunity to circle back with you. So do not hesitate. Any question is a good question. So Tom.
Thank you.
Thank you.
Eric. So our theme has been what for the whole year?
Yeah, wag the dog.
Wag the dog. And guess what happened? The tail just wagged the dog. Tuesday, the inflation report came out. And it was what we call a face ripper, which means that it came in much lower than expectation. Followed by the PPI, which is the wholesale prices. That also came in lower. So what does this mean? The odds of the Fed to raise rates any further have gone down. And we'll talk about that. But finally, it took 10 and a half months, to be right. I actually thought it would happen somewhere around June or July, but it's here. So our forecast has been right. May take a while, but we get there eventually. All right, so there is still a pretty good set of worries out there. So we'll go through them. Obviously, it's the Israel-Gaza war that's going against Hamas and the potential that it expands to Hezbollah or other actors derived from Iran's influence and funding. If that begins to grow and we get into a much bigger situation, because remember the U.S. has different bases around the area in the Middle East, and they're being attacked over 40 times. So the U.S. is starting to very precisely respond to that, but could it expand? It's possible. On the other hand, China and Biden and Xi have just gotten together and really settled things down, the other world superpower, which is good. So the other problem could be that the Feds, no matter if inflation's going down, they're going to keep rates where they are. They're not going to lower them for the foreseeable future, which will keep rates where they are, and high rates end up impacting companies. large companies less so, small companies very much so, or individuals. So small companies are struggling. We'll look at that. And the Fed still, their language is no matter, we haven't really heard a lot since the inflation report came in so good, but they're probably going to keep their hand on the switch that they may say, well, we're going to watch it. One data point's not enough, and they may hit the switch and raise it another quarter point. I think the odds of that are now erased, in my opinion. So we wag the dog. All right. So, but what happens? Well, business debt, and especially for small companies, what the small company was paying 4.65 to borrow. Now it's doubled. It's over 9%. Some say 9.5%. Well, that's a big interest charge on companies that have to borrow to run their business. And it's getting harder to get the loans. So what happens? Let me shift here. We had a lackluster seasonal trend. This normally November, December, and the seasonality of these 2 months are very strong. Up to Tuesday, they were lackluster. Now that has shifted since the inflation report, and that is now beginning to become a normal seasonal trend. The other issue out there is why cheese even here is this economy is not doing well. It's shrinking. And the number of imports the US is bringing in from China have gone down. I think we saw a chart a month ago or 2 months ago that showed that they're in 5th place now in terms of what countries the US importing from. They used to be number 1, but we're not buying as much from them. We're skeptical. Now, Xi, that's why he's here. He's trying to save his economy and sort of smooth things out, because a lot of businesses are not investing in China anymore. In fact, they're reducing. Apple's beginning to find other manufacturing points for them that aren't so risky, especially with the Taiwan-China issue that's going on. Okay, big refinance problems in commercial real estate. That's coming 24 big time. A lot of commercial real estate needs to refinance, but what are they refinancing at? Extremely high rates. And what is the other issue that's going on in commercial real estate? Is that people are staying home and working. So they're not even filling the buildings. So you have sort of this double impact where rates are going to go up and up, the cost of running those buildings. And then, of course, that could end up in a tumbling, and we could have a commercial real estate debacle, because a lot of those refinance dates are 24. So we have some time to see how it all shakes out. I know there's hedge funds that are waiting in the wings to buy these properties at a super discount, but that's still not good for the economy. So we have that coming up. Historically, when Fed interest rate campaign continues, the Fed very rarely will, if ever, get it right, which means they overshoot on raising rates. And then the lag effect of the economy ends up coming up afterward and biting everybody because they didn't shut it down fast enough. It's like a ship going into a harbor, big passenger ship. They have to put the brakes, start braking miles out just to get the boat to slow down. That's similar to the economy with the rate hikes that has been going on. Also, the yield curve has been inverted. And whatever you see, it's been inverted for a while. What that normally says, the average is 13 months after the yield curve, which we just passed. That's just the average. The recession guarantees a recession 100% of the time. Are we going to end up in a recession? We'll talk more about that. And of course, as I said, the delayed impact that's going to shock the economy, which we believe. Now that we agree with some of these we don't. But we do think that this delayed effect is going to hit the economy in 24, and we'll talk more about that. But overall, we're one of the few strategists out there that have been invested. Almost every strategist out there has been a low percentage in equities, because they kept thinking, how many heard on the cable news, recession's coming at the beginning of the year, the mid part of the year. Everybody's been saying recession. We've been saying no recession, and then we've been right. And we had a massive GDP number in the third quarter. We'll have to see what the fourth quarter is, but it beat all expectations. So we do not have a recession that many were expecting, and the percent of hedge funds, institutional funds that have been short the market, the stock market, have been really short as a percentage, which means what they're betting on is stocks to go down. But we had the debacle, the banking debacle, regional banks, when rates went up, their portfolios went down. That shocked the market. It went down, rallied back. Then we had the Hamas-Israel war, or Hezbollah. That went down. We went into a correction. How many know we went into a correction in October? From the peak, we reached -10. That's technically a correction. We've gotten all that back because the market has been resilient, and there's some good things happening in the market. AI is one of them. We'll talk about that, how that's going to revolutionary. So what does that mean? Many strategists have been burned by the bull market that we've been in. There was one strategist, he's on CNBC a lot, and he said that this is the bear market rally of the ages. We're way past bear market rally. We're in a bull market. All right, other positives. Yes, the inflation surprise, face ripper. Both CPI and PPI fall more than expected. And of the 31 components, we're going to look at a graph on this, 24 of the 31 are deflating. Only 7 are inflating. And even residents, the cost of living somewhere, is starting to turn down. It's still inflating, but much less. That's a very sticky number, but that was a surprise too. But that's saying that most of the things that are going on, well, I'm still going to the grocery store, I'm still paying high prices. Anybody? We're still paying a lot for everything. But what it means, that's probably not going to go down. But is it still going up? And I think it's flattening out, and we're going to see that in the upcoming months. Every month they deliver the CPI number and the PPI number. So rates fall dramatically as a result of the inflation data, and both stocks and bonds rallied significantly. We touched 4,500. We went all the way up from low 4,000s to 4,500 in just a day or two. So the market is roaring, and November is very good for the stock market. We think it's going to continue. There'll be some bumps. It's not, a couple steps forward, one step back, but we think it will be higher to the end of the year. There's huge amounts of, another thing I want to talk about is the U.S. consumer debt overall is still very low. Their debt service that they're paying for, it's not up as high as it was pre-pandemic. So that's still okay, but other things are changing, which we're going to look at. So overall, the Fed is done, we believe. And there's a lot of cash, short positions on the sidelines are going to be need to reverse. And when the Fed is done, a lot of stock cash, they're overwhelming number of strategists are bearish. They start getting back in to catch up. They miss the market. They're catching up, so they want to get in because they think we'll be good to the end of the year. And they're covering short positions. That's a big stock booster. A lot of shorts where you make money if the stock market goes down. Well, that's inverts if the stock market goes up. A lot of people lost money. A lot of smart money lost money. But that's gonna, when you cover shorts and you begin to do a catch-up trade, that puts a lot more cash into the stock market. So we have the charts that are going to look at the rally in the stocks has arrived. Strong corporate earnings so far. Stunning inflation report. Importance of market breadth. We'll talk more about that. Seasonality is good for November and December for stocks and bonds. Fed pause is really good for stocks and bonds. All right, here's this is 92%. Now Target came out after this was last report, so they bumped that up a little bit. Target's, how many know Target's numbers came out very strong, and the stock rallied over 10%. So, but what we see is that 82% of the companies that have reported, which is the majority, 92%, have beaten their analyst expectation. And look how much they beat it by, almost 7%. That's a big number. So the analysts got it wrong. You know, I think the more I look at analysts and I don't even know why they get paid. These stock analysts, they're very rarely right. And they seem to undershoot, overshoot. I wouldn't want to be an individual stock analyst. Okay. So, but you can see the numbers are good. Now here's the inflation hit a wall. This is what caused the market to take off, both stocks and bonds. And then you can see, I don't know if you can see this, but 7 are inflating, but all the 24 are going down, flat or down. That's deflation. The inflation hit a wall, and that could go up next month. So we're starting, even housing or residential costs are starting to slow down. This is all really good. So with this kind of report, now remember Fed Powell saying, Chairman, that he's got us, you know, we're not going to go by 1 or 2 inflation reports, but it's not giving them evidence to raise the rates anymore. So that's why the futures are flat for anymore. Okay, this is a little more something I need to explain. I think I showed a chart, I can't remember, but I believe I did, where it shows that the stock market, the S&P 500 is being driven by 10 companies, tech companies. The tech performance, the QQQ or the NASDAQ is up big for the year, and it impacted the heavyweights that have the most influence on the overall return of the S&P 500. So that's not good for longevity of the stock market. So what the market needs to do is the rest of the stocks need to start rising above their 200-day moving average, which just shows they're going up. But right now it's been concentrated. That turned on Tuesday. We saw the equal weight S&P 500 versus the cap weight, which has a big influence by the top 10. Equal weight means everybody's equal. That outperformed the cap weighted. So we're starting to see a migration back to other stocks that have not been doing well. And this is what will be necessary for the next bull market, for a continuation of this bull market. And you can see it's very low down here. The participation underweight breadth. That's not normal. That's below normal. So that's not good for stocks to continue. Now let's look at this from a little different perspective. If you look at see the far left bars are much higher and go down as we go across. See that get a much higher numbers. This is the forward returns, 3 months, 6 months, 12 months out. And what the bottom y-axis or x-axis is saying, this is where there's a high participation where more companies are over their 200 moving average. And what that means is that when you have a lot of companies that are doing well, not just 10, that bodes well for the next 3, 6, 12 months. And as this is the next quintile, that's only 72 to 81, it goes down, and only 162 to 72, still positive. But look what happens if you get below that 62% mark. The returns don't last 3, 6, 12 months out. This is what we call market breadth, the number of companies participating that are doing well. We need a lot more companies to do better. If that happens, we're going to have much higher returns, and it helps propel the bull market. If it doesn't, you can see it gets a little rough if we only have 10 stocks doing well. Does that make sense? Hopefully. Okay. All right. This is what happens, not when they drop rates, but this is when the Fed pauses, is done. Look at the returns. This is a lot of different dates where the Fed was done. And you can see, not necessarily lowered rates, but they were done. You can see the stock market return was very strong going through, and especially the last 3 were really strong, and the last 2 specifically, the events when the Fed was done. Both, you can see typically stocks do well, Now, every once in a while you get an anomaly like that one. But this, you can see how well the last time the Fed paused, the market was up 65.8%. Bonds were slightly negative. Now we're expecting something like this going forward. Bonds look really attractive, and so does stocks at this point. If the market breadth begins to expand. So Fed pause is good for stocks and bonds. All right, stock market returns. These are the returns all the way back to 1980. Where are most of the bars up or down?
Most up.
This is November and December, what we call seasonality. November and December are normally, except for a few, a good time in the stock market. You get past that October period, and guess what's happening this November? Stocks are up big, bonds are up big. So this is the stock market. What it shows is the seasonality is pretty strong on average. You get 3.5% positive for stocks in November, December. So those are normally good months, and we're experiencing that. We looked at this over a couple months ago. We saw this, so we thought this is a good time to be in the season of November, December. Now, prior to the inflation rate, this wasn't much so. It was lackluster, but that's now changed because of the great inflation downturn.
Shifting gears a little bit.
Okay, now we're shifting because we'll see this at the very end. But what are we seeing? We're seeing signs the consumer is starting to pull back. We think, and we'll talk more about that, but I got some charts. Are we experiencing potential downturn with consumer spending? Remember, what percent of the GDP of the economy, gross domestic product, is consumers? Anybody know?
Half?
70%. Consumer spending makes up 70% of the GDP, our overall economy. Well, what's happening is the personal savings rate. This was the pandemic. Remember how much people save money? They didn't go anywhere. We didn't travel. We didn't go out to eat. We stayed in our homes. Well, money starts piling up. But now look where it is. And we've been talking about this for several months, that the savings is going away. And percent of disposable income. And so what that tells me is that the consumer, with rates still high, and now they have less to go out and splurge. Remember, we were so locked up in our homes. Everybody traveled. I got to get out of here. Bought Polaris boats, bought Polaris four-wheelers, but Polaris did well during that period. They couldn't wait to get out of the house, and so that's going to start slowing down. I think airline prices are coming down. Not yet. We're starting to see them come down a little bit. And what's saving airlines right now is that the fuel costs have been contained. Even with the Hamas-Israel war, it hasn't really spilled over into the oil markets. So anyway, this is showing that's almost done. Now, U.S. persons. Okay, now here's credit card balances. They've climbed to $1 trillion, over $1 trillion. And so this is credit cards balances are starting to go up. And that you can only put so much on your credit card. And they're high rates. And have you ever looked at the rate of a credit card? Pay them off. Because but this is a problem. This is showing, look at the steepness of this. There's been more and more credit card balances. That's what's keeping the economy going. People are still spending, buying stuff, consuming when they don't have the money for it. Savings has gone down. So what do? I want to keep that same shift. I want to keep having fun. So what they do, they put it on their credit card. I'll deal with that later. Right?
Ish.
None of you are on that track, right? Except John? No? All right, good boy. All right.
I've been reading about the credit cards going up in the 20 or 24% on credit cards, and people are just not spending as much because they're running out of credit card stuff. is that gonna have a big effect on the economy, the credit card debt?
Yeah, I think it will. It hasn't hit yet, but it's getting to that point where there's a tipping point where that becomes a major issue. But a lot of it's in the subprime category, low income, lower income. They're in really high prices. They had all the stimulus money. Well, that's running out. And so now things are going to get really bad. And then you have the student loans. I just saw something this morning on the student loans is going to impact spending in the younger people. They said this Christmas, they're all pulling back.
So how it's twofold, right? You run out of credit available to spend.
Yeah.
And then with interest rates going up, your payment on that debt is going up,
Yeah,
which leads into this chart that Tom has of how many people are not making their payment.
yeah,
So this is autos. And you can see credit card delinquencies. How many are behind? Well, which way are they heading?
yeah.
They're both going up. This is not good for the overall amount of people that are going to be still consuming. So we're not in a disaster, but we're kind of moving that way. And some economists are saying, I just read one, they think it's going to slow down, but not, too much. It's going to go down, but it's not going to go too much. We're kind of the sense that it's going to go too much. We'll talk about that. Not yet. Not yet. Okay. This is another problem. Lending standards. You want to get a loan? Good luck. It's tight. Banks are requiring much more to get especially if you're a small company. This is restrictive. You can see what happens. See these gray areas, the shade? That's recessions. What happens before the recession? Lending standards, tough to get a loan. Boom. Tough to get a loan. Boom. Tough to get a loan. Well, right here, that little short recession we had from the pandemic. Now look what's happening. It's going back up again. So very hard to get loans today for companies. And then you're paying twice the interest rate you did before. So my profit margins are going down. This is not good. I can't play. I'm not going to hire any more employees. I've been reading about equipment that people need, companies need. They can't really buy it anymore. It's too hard to get a loan, too expensive to get more equipment to expand their business. This is just starting to be an issue. Okay, another thing is business labor conditions. You can see that labor is starting to roll over, and you can see what happened: recession. What happens? These numbers of net compensation plans, what the expectation is for a company, net hiring plans over the next 3 months, a percent of firms with positions not able to fill. All these are starting to roll over. Now you can see employment's been really good. But look at the direction of those 3 lines. They're starting to go down. So the things are going to change. There's going to be, in fact, we just had the number of people that are looking to get money because they're out of a job. That has just jumped to we haven't seen that number for what, a year and a half. So we're starting to see some cracks in the economy. That's what all these charts are saying. There's cracks in the economy. We're okay right now, but we see something happening in 24, which we'll get to at the very end. AI, game changer. This potentially could keep us out of a recession, or just limit the downturn. Is that the things that are happening in AI are moving so fast, and can be illustrated by this next chart. This is the exponential advances in AI. Now, they call it the number of parameters selected in OpenGPT models. Now you can see 2018, how complex the models were. We're figuring things out. Got it better. But look what happened with the ChatGPT. They're off the chart. What's that saying is that companies and people are starting to use AI in a more complex way, which will help productivity, help profit margins, and help people live even a more higher quality life. Many jobs will be taken over eventually by AI. So if you want a job going forward, you want to be the person that fixes AI. But you can see how fast it's moving.
And this
Black-
chart is not to scale. I mean, look at the numbers down there at
Yeah,
the bottom.
it's not to
If
scale at
if it
all.
were, we would need a
10,000.
screen that's really wide.
Yeah, you can look at 1 million. This is how fast it's moving, how complex and how robust are these AI models they're building. It's off the chain. And this is going to help a lot of businesses. Now, right now, businesses are scrambling. How can I use AI to benefit my company, my unique type of company? And there are many companies out there trying to help companies harness this. I use AI. I'm using it every day. So it's something that's available. It's so easy to use, and it's really taking off. This is the 10 million, 1 million from 100. That's how exponential changes. It's gonna, you'll see this will all start unfolding in the next year to 2 years. And companies will be able to harness this data. All right, so here's my outlook for the rest of the year. Inflation will continue to fall. We don't think it's just a one-shot wonder Tuesday. We'll reach the Fed 2% target by maybe December or January. The Fed is done raising rates. And you watch, nobody's saying this, but we're gonna have a shift. They're always talking, right, on cable news about the next rate hike potential. Are they gonna raise it 25? They're still hawkish. That narrative, I believe, will shift to when are they gonna lower rates? And especially if the economy starts pulling off. Now, we're talking not until July. There's a first rate decrease by the Fed. That may be pushed up if my scenario begins to unfold. So we think the narrative is going to shift. When are they going to lower rates? I think that will be the argument. Now, not if they're going to raise rates. All right. So that's the shift. Stocks rally to the end of the year. It'll be bumpy, but I believe they'll be higher than they are now. And bonds will rally to the end of the year and into 24. Because stocks and bonds are going to benefit from lowering the rates, interest rates coming down. Stocks will do better this year. Bonds will do good. But when NAG 24 comes, if my scenario is right and the economy starts rolling over, bonds will continue. And then stocks will come down, maybe a correction or even a bear market next year. So bonds have kind of a win-win. This year, win-win for stocks and bonds, and then suspect with stocks next year. Maybe the peak will be January, maybe mid-December. I don't know. But we still look for a forecast. So we're about 4,500. We raised it another 100 points. I said 4,600 when?
A year ago.
A year ago. That's 2 years in a row. I got the number exactly right.
It's uncanny, Tom.
I think 3 years.
Kreskin.
Yeah. I'm cheating. I'll tell you how I'm doing. Okay. So, but I got this right too. We hit 4,600 already, and I said that in December. So we went to 49, but I pulled that back because that was before the Hamas and Israel war.
You hit your year-end target in July.
So somewhere in there, I think we'll end up. So that means we got a little more upside in stocks. More upside in stocks than bonds, but then bonds will continue, in my view, in 24, and stocks could get bumpy. So stocks peak sometime as I said, in December, January, but then our 24 forecast, which we've talked about, I'm going to just keep reiterating, or how you're supposed to say that? Recapitulate. Can I recapitulate? We're going to recapitulate. All right. Household pandemic savings gone, high interest rates finally slow economy. Consumer spending slows significantly. Fed aggressive rate hiking overshoots. The late economy ends up hurting economy more than expected. Corporate earnings start to fall. Stocks go into a correction or bear market. First half of 24, not this year. Somewhere first quarter, end of first quarter, first to second quarter, we get hit because of the economy slowing. Now, we said it wouldn't slow this year. We were right. I think we're gonna be right on this one too. I want a bonus. If I get this right, will somebody buy me a piece of cake?
He wants to have his cake and eat it too.
Bonds rally, even though the consumers pull back, bonds will continue rally. Why? Rates are gonna go down, probably 350 to 370 in the 10-year yield. But it will, as always, if we get hit earlier, stock market discounts the future and it'll start rising somewhere probably in the second half, even though we got bumped up in the first half. Because remember, when you're in a recession, the market's looking out a year and a half. What will a year and a half down the road? So it's a discounting mechanism. It always moves before the economy. So that's my 24 outlook. It's not overly exciting, but we want to structure portfolios and we have a plan to structure the portfolio. So pray for us that we get it at the right time. It's tricky, but that's our goal, is to structure the portfolios for this. Any questions?
Most of the treasuries are going to come due in November. And with China not buying, Russia not buying, the Federal Reserve's gonna have to buy.
They're probably not going to buy it. They're actually reducing their purchases. That's called, quantitative easing is where they buy more. They're not easing anymore. They're quantitatively tightening. So they're not going to come to the rescue. They're going to let the market figure it out. Pension funds, there's a lot of people now look at bonds as a pretty good investment. So there's going to be more buyers of US treasuries. But it is a problem. Our debt service is going up and it's a huge problem down the road. But the four other forces, I think, outweigh that. So I think bonds rally to the end of the year. Treasuries even included.
But the interest rate's gonna be like the 4.5%.
Yes,
So the interest that the federal government pays on it is gonna be more than we're putting into the cents.
that is true. And this is why the politicians need to get their act together. They all talk about it, but you got, unless you have action, it doesn't mean anything. But you're right, it's a problem. But the Fed's not going to come in and buy right now. They're going the other way. They're reducing their purchase.
So inflation is gonna be.
No, not necessarily. Inflation's going the other way. What it means is that treasuries probably will rally less than normal, but they will rally. They'll be dampened because of the number of treasuries that are being issued going forward. But it is something we're watching. Now, if the Fed, if things really go bad with the economy, they may start doing, they may go the other direction, quantitative easing, which means they'll start buying more treasuries. But right now, that's treasuries look like a good buy, especially if we go into a slowdown next year. They'll be one of the few winners out there. Because if rates go to 3.5, treasuries rally big time. We're in double-digit returns for a 10-year.
Just a reminder, anybody online, I see that you're out there. I don't know who's out there, but I do see that we have a number of you online. If you have any questions, don't hesitate. Post them in the comments section. Shoot me an email directly. We also have an Ask a Question button on the website for this event. Love to field those questions for you. So I am watching that right now if anybody has any questions. And of course, if you're watching this in the replay, don't hesitate as well. I will be watching that, and we would love to circle back with you if you're watching this a week from now, 2 weeks after this event, what have you. Would love to circle back with you. Got another question in the room though.
Yeah, I know on the chart you were talking about the credit card debt is going up and up, and a lot of people are not meeting their minimum payments. They're defaulting on a lot of stuff. And to me, it sounds like they're gonna get worse. And what's it gonna be like next July?
That's why we're painting a kind of negative economic scenario for next year. We do expect that this will be a problem. We think a lot of it has to do with people have already traveled now. They got out of their house. And they spent a lot of money that they had saved up from not doing anything. That money's now gone. And you still have high rates. You know, this is why I think the Fed's gonna have to lower rates sooner than July. If they do, that even puts a greater opportunity in fixed income, treasuries, corporates. I'm bullish on bonds and stocks this year. I'm bullish on bonds this year and next year, not so much stocks. But the second half, stocks will come back. And then the AI impact will really start hitting companies. So I think we're gonna have a probably good second half in the stock market next year, but not so in the first half. That's my forecast. It's subject to change. The stat is only good today.
That's such an important point, and that's a great question and something to keep in mind. But remember, between now and 6 months from now, we're gonna be looking at this, 180 days or something, right?
Now, we're data driven, so we can forecast all we want, but at the end of the day, we gotta see data confirming a forecast.
And I love his term that you used, Tom. It's the weight of evidence.
The weight of
So when we
evidence.
look
So
at
we
the
need to see
good
more.
and the bad. What does
I
it
can
all
s-
mean,
Yeah, I
right?
can say this is gonna happen, which I've been fairly right, but I gotta see it in the numbers. The information, the data points coming forward. We're weight of evidence, data driven, so.
What do you think would be some of those earlier signs that the Fed has overshot
Consumer.
the consumer? So
Yeah.
that's what we're seeing
Yeah,
already.
yeah, I think we're starting to see the beginning of that.
Those are the early signs already.
Yeah,
Sure.
those charts were early signs that things are starting to not do it. Now, when the middle class and the upper class start pulling back, then we get a real problem. Upper class is in good shape. But it's the middle is holding things up right. The lower class is starting to fall apart already. But if that spreads to the middle class, then we're gonna have an issue. Remember, 70% of our economy is consumer spending. It's a big number.
Turn sound on the digital dollar.
That's coming. I don't know when, but that's certainly, Bitcoin made a recovery. It's in the 30,000s. You own Bitcoin?
Yes,
Okay, that came back. There's, Woods, what's her name?
Kathy Wood,
Kathy Woods says it's going to 1 million. I don't know.
if you
It's
Heads
well, it
shaking in the
goes
back
up
of the
and it
room.
goes down. It's to me that if you're gonna be in Bitcoin, you wanna trade it. It's just such a small, I wouldn't recommend putting much in it, but
and
maybe you're fully in it. I don't know.
on that
After
note,
net worth,
we don't make recommendations on Bitcoin.
No, we don't.
We don't, and we can't.
Well,
So,
look what's happening.
Don't take anything that we're saying
It's
today
going
as
like
a
this,
recommendation.
and this, and then this, and then this, and now it's up a little bit. It's in the middle.
if the SEC starts to give approval to the ETF, so it's like BlackRock and money.
Right? That's beneficial. But that's already discounted. That's gonna happen. In the pricing of Bitcoin, they're saying it is gonna happen. It's already in the price. That's what brought it from the 20s or 8, whatever it was recently, below 20 to 30s, 30,000. So that's already discounted. That's gonna happen. Now that will help in the long term. All it does is make it easy to buy through a product of a company like BlackRock, the biggest investment firm in the world. They're going to back that product. So if hackers come, whatever, they're going to reimburse people. So that would be a safe place to go, to a BlackRock ETF to buy it. However,
Well, relatively speaking,
it's not something. We've avoided it, and there's a reason, because it's gone up and down, up and down, up and down. And what you want with a alternative investment is that when the stock market goes down, the alternative goes up. So you're ebbing and flowing to balance the portfolio. Unfortunately, when the stocks go down, Bitcoin has gone down more. It hasn't been a hedge. That's one of the big reasons I don't like it.
It's still in the category of speculation.
High speculation.
It's not tried and true investment strategies, stock market, bond market, the things that have been around for a long time. It's still in its own category of speculation. It's a very high risk type investment.
But it's not going away. So it's your,
If they approve all these ETFs, that's gonna stabilize the issue.
hopefully they go, but I would want to see its action relative to stocks. If stocks go up, does it go down or stay flat or the big thing is if stocks go down, can I have it as a diversification play? It hasn't been a good diversification for stock and bond portfolios. And the 60-40, Harvard came out with that back in the 60s. You put 60% of stocks, 40% in fixed, has done terrible. But I think it's a good time to be in it now. Because I look at bonds and stocks doing well. And bonds have they lost 13 to 18 depending on the quality. Last year they were down 3-4%. This year, just a few weeks ago, now they bounced. But I think they're going forward, bonds and stocks will do well. And then the shift goes to bonds sometime in 24 if our data comes in and we see that. So we do have a plan. We talked about it. But not yet.
I have one more question.
Yes, sir.
When are you gonna upgrade that picture, Tom, that you lost all
I
this
know,
weight?
I've lost all this weight.
Doesn't look like.
And
you.
get the photographer
Yeah,
back
can we
out
get the
here.
guy back?
Let's do it. Let's do
With
it.
AI, can't we just,
Yeah.
Danielle,
It's called
something in there.
Photoshop, isn't it?
no, we can just Photoshop the head.
You do look great.
I know, thanks.
I know, he said. I know.
Now that he's got me on this pee stuff, I feel even better.
Love it. Well, I don't see any other questions out here. We of course will stick around. All of you guys stick around for lunch. We'll have that out here in just a second. Just a future reference for you guys. Our next monthly update is scheduled for Thursday, December 21st.
Okay.
So mark your calendar. Wait patiently every day for that next event. And then of course, as always, every Monday we do an update. Monday mornings, how I start my week, 9 a.m. Go live online with a brief update of what's going on in the market. So mark your calendar. I don't see any other questions coming in here, so I will sign us off. Thank you guys all for your participation. Really appreciate you. Tom, as always, thank you very much for this weight of evidence balanced approach. We appreciate seeing all sides of the conversation. So with that concludes our presentation. Thank you all for joining us. If you are online or in the recording, thank you for being here as well. Bye, everybody.
good job.
All of those peasants laid on the ground, coming Indian.
The most.
Where do you put it? You got that big family?
I did pretty good. We actually don't really eat them, so I let other people take them. If anybody wants some pheasant, I can get some pieces for you.
It's been sitting out in the car.
Yeah, it's out of my truck right now.
Yeah, it looked a little chilly. For what?
It was supposed to be really cold, and then it turned out to be wonderful.